In 1999, the stock market was unstoppable. Technology companies were exploding in value. Internet startups were becoming billion-dollar businesses almost overnight. Investors believed they were witnessing the beginning of a completely new economic era, and in many ways, they were right. The Internet was about to transform communication, commerce, entertainment, and nearly every industry on Earth. But there was one man who refused to join the celebration: Warren Buffett. While the world was pouring money into technology stocks, Buffett was doing something very different. He was watching the numbers. And when he compared the value of the entire stock market to the size of the real economy, he noticed something strange, something dangerous. A single number had climbed to levels never seen before in modern financial history. To Buffett, this wasn't excitement, it was a warning. Months later, the dot-com bubble collapsed. Trillions of dollars vanished from the market, and the indicator Buffett had quietly been watching became one of the most important valuation signals in finance. Today, that same indicator is rising again. It's called the Buffett Indicator, and many analysts believe it may be flashing another warning. But what exactly is the Buffett Indicator? Why does Warren Buffett trust it? And what does it say about the stock market right now? By the end of this documentary, you'll understand the math behind Buffett's most famous market signal and what it might mean for investors today. Before we dive deeper, if you enjoy cinematic finance documentaries about Warren Buffett's strategies and investing philosophy, make sure to subscribe to Robert Jenkins. This channel is dedicated entirely to understanding Buffett's ideas and the logic behind his investment decisions. Now let's start with the foundation. At first glance, the Buffett Indicator sounds complicated, but the concept behind it is actually very simple. It asks one basic question: how expensive is the stock market compared to the real economy? To answer that question, the indicator compares two numbers. First, the total value of the stock market. Second, the gross domestic product, or GDP. GDP measures the total economic output of a country. It represents the value of everything produced within the economy: goods, services, infrastructure, business activity. When you compare the value of publicly traded companies to the size of the economy, you get a ratio. That ratio tells you how expensive the stock market might be relative to the real economy. If the ratio stays near historical averages, markets may be reasonably valued. But when the stock market grows much faster than the economy, the ratio climbs. And when it climbs too far, investors may be paying prices that assume extremely optimistic future growth. That ratio is what we call the Buffett Indicator. Warren Buffett has spent more than 60 years studying markets. Throughout his career, he has witnessed multiple financial bubbles: the Nifty 50 bubble in the 1970s, the dot-com boom of the late 1990s, the housing bubble before the 2008 financial crisis. And during each of these periods, Buffett noticed something interesting. Investor optimism often grows faster than economic reality. People believe the future will be dramatically better. Stock prices rise, valuations expand, and markets become disconnected from fundamentals. That's why Buffett values simple indicators that compare financial markets to real economic activity, because ultimately, companies earn profits from real economic demand. If the stock market becomes far larger than the economy that supports it, valuations may become stretched. That's why Buffett once described the market cap to GDP ratio as probably the best single measure of where valuations stand at any given moment. Let's walk through a simplified example. Imagine the total value of the U.S. stock market is $50 trillion, and the GDP of the United States is $25 trillion. To calculate the Buffett Indicator, you divide the market value by GDP. 50 trillion divided by 25 trillion equals 2. Multiply by 100, and you get 200%. That means the stock market is worth twice the size of the economy. Historically, analysts interpret the ratio using approximate valuation ranges. Below 75%, the market may be undervalued. Between 75 and 100%, fair value. Between 100 and 150%, potentially expensive. Above 150%, historically elevated territory. Again, this does not guarantee a crash. But it suggests investors should pay attention to valuations. Before we continue, let me ask you something. Do you think the stock market today is expensive? Or do you believe technological innovation justifies higher valuations? Let me know in the comments. One reason investors respect the Buffett Indicator is its historical context. During the late 1990s dot-com boom, technology stocks were skyrocketing. Internet startups with almost no profits were achieving billion-dollar valuations. Investors believed the internet would revolutionize the global economy. And again, they were right. But the market had moved ahead of reality. The Buffett Indicator surged to record levels. Then, in 2000, the dot-com bubble burst. Technology stocks collapsed. The Nasdaq fell nearly 80%. Trillions of dollars disappeared. Another example appeared in 2007. The housing market was booming. Credit was easy. Investors believed financial institutions were stronger than ever. Once again, the Buffett Indicator had climbed above historical norms. Then came the financial crisis of 2008. Banks collapsed. Markets plunged. And again, valuations had become disconnected from economic reality. Over the last decade, markets have experienced another massive rally. Technology giants have expanded dramatically. Companies like Apple, Microsoft, Amazon, Nvidia, and Alphabet have reached extraordinary valuations. Artificial intelligence has created a new wave of optimism about the future. At the same time, global investment capital has flooded into equities. This has pushed the total value of the stock market to unprecedented levels. But GDP growth has not always kept pace, which means the Buffett Indicator has climbed again. At certain points in recent years, the ratio has approached 180 to 200%. For some analysts, that number raises important questions about valuation. But the story is not quite that simple. If you're learning something useful from this breakdown, consider liking the video. It helps more viewers discover documentaries about Warren Buffett's investing philosophy. And if you want more videos like this, subscribe to Robert Jenkins. Even Buffett himself has acknowledged that the indicator has limitations. Modern companies operate globally. Technology companies generate revenue from customers around the world. A company like Apple sells products in dozens of countries. Microsoft provides services across multiple continents, which means comparing U.S. market value only to U.S. GDP may not fully capture the global scale of these businesses. Additionally, interest rates play a major role in valuations. When interest rates are very low, investors often accept higher stock valuations. Why? Because alternative investments like bonds provide lower returns. So while the Buffett Indicator is useful, it should not be used as a precise prediction tool. Instead, it provides context, a way to understand whether the market environment might be becoming overheated. When markets appear expensive, Buffett rarely panics. Instead, he slows down. He waits. Sometimes Berkshire Hathaway allows cash reserves to grow. This patience has been one of Buffett's greatest advantages. He often compares investing to baseball. In baseball, a batter must swing when the pitcher throws the ball. But in investing, you can watch thousands of pitches go by. You only swing when the opportunity is right. Buffett calls this waiting for the fat pitch, the perfect investment opportunity. Chapter 8. Why Discipline Matters. One of the biggest challenges investors face is emotional decision-making. When markets rise rapidly, people feel pressure to participate. They see others making money. They fear missing out. But Buffett has always emphasized discipline. He avoids chasing trends, he focuses on long-term value, and he waits for opportunities that meet his investment criteria. That patience has allowed him to outperform markets for decades. The Buffett Indicator is not a crystal ball. It cannot predict exactly when markets will rise or fall, but it offers something valuable: perspective. It reminds investors that the stock market and the real economy are connected. When stock prices rise much faster than economic growth, valuations may become stretched. That doesn't mean panic is necessary. But it does mean investors should remain thoughtful and disciplined, because history shows that markets move in cycles. And patience is often the most valuable asset an investor can have. Final outro CTA. If you enjoyed this documentary about the Buffett Indicator, make sure to subscribe to Robert Jenkins for more deep dive videos about Warren Buffett's strategies and investing philosophy. And in the next video, we'll explore another fascinating question: why Warren Buffett is holding over $200 billion in cash, and what he might be waiting for. Thanks for watching.